Hello everyone, can you trade without risks? Absolutely not, but you can trade with minimal risk and good profit using the Bounce from Liquidity Walls strategy. Learn about it in this guide. Eugene here. Like, subscribe, let's go. A liquidity wall in trading is a concentration of large buy or sell orders in the order book. These orders form levels that can influence price movement. If there are many buy orders at a single price in the order book, it can create a support level. The price is less likely to fall below this mark. If there are many sell orders, it can create a resistance level, preventing the price from rising. In a trader's terminal, this looks like a significant block of orders at a specific price point. For example, there's an order at the price of 1.635 for $767,000. That's shown in Figure 1. Meanwhile, most other prices show orders between $10,000 and $50,000. Figure 4 shows the time frame we're looking at, in this case 1 minute. In Figure 3, you can see the total trading volume during that minute. It ranges from $80,000 to $250,000. And in Figure 2, we break that down by price levels. Each level shows how much volume was traded there, from as little as $1,000 up to $80,000. This tells us that the $767,000 order is too large to be filled right away at the current trading volume. This particular order is a sell order, acting as resistance for the price. The price will not go above this order until it is filled. In other words, the price will bounce off this liquidity wall and move downwards in this example. For a buy liquidity wall, the price would move upwards. This is how the strategy is formed. As an active trader, you watch the market every day, look for promising setups, and review your trades. That takes a lot of time. That's why we created Takert, your trading co-pilot. It shows you the full market picture, helps you catch the best opportunities, and automatically tracks your trading stats. Takert takes care of most of the routine, so you can focus on what really matters. Sign up using the link in the description. And if you want to master scalping, check out our course, Impulse Hunter. The link's down there too. Since we assume that the price will not go beyond the liquidity wall, we use the following trade setup. We place our orders just before the liquidity wall so that our orders are filled and we enter the trade. We set a stop loss immediately behind the liquidity wall in case this large order is eventually filled. We then wait for the price to move away from the liquidity wall, which will be our profit in the trade. As a result, we get a trade with a very small stop loss and a high probability of price movement in our desired direction. Often, the stop loss is less than 0.1%, while good bounces yield 1% or more. The risk and reward ratio is 1 to 5 or better, even considering transaction fees. This sounds incredibly simple, but there are nuances and risks associated with trading. The biggest risk for any trader using this strategy is that the liquidity wall might not be real. Someone who wants to manipulate the price can create such orders, showing traders false information. As soon as the price approaches the order, the manipulator will remove it, and the price will continue its movement. The manipulation won't work, but those who planned to bounce off the liquidity wall will lose money, as their orders will be closed by their stop loss. Such manipulators are called spoofers, and their orders are called spoofing orders. There is no absolute protection here, but there are recommendations to reduce the chances of losses. First, ideally, liquidity walls should be at round numbers. When a real order is placed, it is more likely to be at a price like 1.010010, 1.04050, etc., rather than 1.03274. Second, it's good when a liquidity wall stays in the order book for a long time. Spoofing liquidity walls are often added and removed quickly. They blink, so their lifespan is usually short. Third, with experience, you can wait for the price to approach the liquidity wall. If there were trades at its price and the liquidity wall did not disappear, then enter the trade at market price if it hasn't bounced too far yet. Even when a liquidity wall is real, there are nuances that can lead to a stop loss or increased losses. Squeeze, price slippage after liquidity wall execution. In the example, above the liquidity wall, there are orders of $13,000 to $33,000. If the volume of stop losses behind the order, along with buy orders at the moment of liquidity wall execution, is significantly larger than these figures, the price will sharply move upwards. Thus, the stop loss will not be triggered at the price it was set, but at a much higher price. A 0.1% stop loss can easily turn into 1 to 3% or more. If you don't use a stop loss at all, things can be even worse, as for everyone who trades without stops. A 2% squeeze plus 5 times leverage, for example, is already a negative 10% loss from your deposit. Therefore, it is also important to assess risks here. Do not increase volumes and leverage without sufficient experience. You can improve this situation as follows. As soon as you find a liquidity wall and decide to participate in a trade, enter the trade at the current price with a minimal volume. For example, $7 to $10, and immediately place a stop loss behind the liquidity wall. All orders have an execution priority. The earlier your stop loss is placed, without changes, the better price it will be executed at, and the squeeze will be smaller. Only after this initial small entry and stop loss is set, place orders for the entire planned trade volume. Price may not reach the liquidity wall. The price may reverse earlier or not reach the liquidity wall at all. Divide your entire volume into several parts and place them within 0.1 to 0.3% of the liquidity wall. The larger the volume, the closer to the liquidity wall it should be. If the price did not reach and did not fill your order, it means there was no opportunity to work out this situation. This is absolutely normal. Do not try to chase the price and make impulsive, emotional decisions. It's especially frustrating when the price reverses earlier and gives a few percent profit on a $10 initial entry, but what can you do? Probability of breakout and stop loss with squeeze. For example, if we had a liquidity wall at 0.03140, if it is clear that the price has already approached this level or liquidity wall several times, it is very likely that it will be executed. There might be an impulsive breakout with a squeeze of stop losses for those who expected bounces from the level liquidity wall. In the example, the breakout occurred on the fourth attempt, but it's better not to trade bounces from liquidity walls after the first approach. Until you have experience in identifying exceptions, it's better to trade only the first approach to a liquidity wall. You won't have to open coins on exchanges one by one and check their order books. For this, our co-pilot for traders, Takert, has a liquidity wall screener that does this job. The displayed information includes coin on the exchange, price where the liquidity wall is located, size of the liquidity wall, percentage distance of the liquidity wall from the current coin price spread, estimated time for the liquidity wall to be eaten up, based on trading volumes, lifespan of the liquidity wall when it appeared in the order book, and a chart with the liquidity wall. All this allows you to assess whether this liquidity wall is suitable for a bounce or, for example, for a breakout, which is another strategy. For example, at the time of writing this guide, an example for the Pengu coin, a liquidity wall was discovered at 0.03110 around 950. The price approached it precisely around 1110. As a result, it bounced first by 0.12% as a basic target, then by 0.25% as an optimistic one. To avoid constantly monitoring the table, I use the following notification, which is sent to Telegram. These are new liquidity walls on Binance, with a volume of $500,000 and a distance of up to 1.5% from the current price. I also specify that the trading volume on the coin should be from 20 million per day to exclude illiquid coins. In the blacklist, I added coins where liquidity walls are usually spoofing or do not affect anything, and the price moves freely through them. Also, by default, the following coins are filtered: BTC, ETH, XRP, BNB, EOS, SOL, and some others where liquidity walls are large but meaningless. I do not set the time for eating up or discovery time, as I use this notification for other strategies as well. However, you can set the time from 10 minutes and eating up from 1 minute. All screeners find liquidity walls using the same algorithm. However, the abundance of displayed liquidity walls does not mean that all of them are working and that there will be a bounce from all of them. It would be too simple. In addition, there are risks discussed above. Practice is essential here. 1. Identify liquidity walls for a bounce. 2. Situations when it might occur. 3. Check possible risks. 4. Determine trade targets, how many percent to pull a bounce, and when to close a position. 5. When you can enter early or chase at market price. All this definitely requires experience. Therefore, you can make the first 20 to 30 trades using this strategy with a minimal volume up to $30. The first 10 to 20 trades can be on all coins indiscriminately if you are too lazy to figure it out. This will form a blacklist and the main nuances of the strategy. The remaining 10 trades will be more conscious to also collect statistics and see how everything works. After this, you should probably understand how to trade using this strategy. Depending on market conditions, the norm can be completed in 1 week. As with other strategies, it's important to wait for good liquidity walls and trading situations according to the strategy, and not to jump into everything, guessing the direction of the price. General trading rules: do not overstate volumes and leverage. Observe risks. All this is also relevant. As for any strategy, the bounce from liquidity wall strategy is the simplest with the least risk for beginners. It's also used by experienced traders. As the price movement scenario, possible risks/rewards are very logical and clear here. Also, don't forget that the link to our co-pilot for traders, Takert, and the Impulse Hunter Scalping course are in the video description. If you like the idea, hit like and subscribe. Let's make trading clear and simple. Thanks for watching, and good luck with your trades.